Building a seaport from scratch requires fighting the ocean itself. Before you can even think about turning a profit, you pour billions of dollars into concrete seawalls just to hold back the tide. This image shows a dredger actively excavating the ocean floor. This industrial-scale dredging is a mandatory sunk cost. You have to carve out water deep enough, creating what's called a deep draft, so that ultra-large vessels can actually pull in without hitting the bottom. Here is the trap. You have to spend all that capital up front. If you finish the port and global trade slows down, your docks just sit completely empty. You still have to pay off the loans for the concrete and the dredging, but you have zero money coming in. For decades, building maritime infrastructure has been a high-wire act of predicting global shipping volumes. If your predictions are wrong, those fixed costs will bankrupt you. Knowing how dangerous that math is, you would expect companies to build very slowly. But JSW Infrastructure is currently expanding its cargo capacity by 63%. If they win the bid, they take on the construction costs, but in return, the government grants them the exclusive right to operate that specific terminal. No competitors are allowed to build next door. This graph illustrates the power of operating leverage. Once the initial cranes and concrete are paid for, those fixed costs level out. From that point on, the cost of moving 1 extra ton of cargo drops close to zero. Every additional ship that parks there is almost entirely profit. To make that math even better, these long-term concessions allow JSW to escalate those tariffs year after year, linking their parking and cargo handling fees directly to inflation. Having a 30-year monopoly where you can constantly raise prices is a mathematically perfect business. But it relies on one critical assumption, that the ships actually show up. To guarantee the ships arrive, JSW Infrastructure leans on its corporate parent, the JSW Group conglomerate. The parent company operates energy plants and giant steel mills. They require an uninterrupted stream of raw materials. They have to import millions of tons of coal and export finished steel coils across the globe. The conglomerate signs what is called a take-or-pay contract with JSW Infrastructure. The family business promises to pay the port for moving a specific volume of cargo every single year. If the steel mills have a slow month and don't actually ship that cargo, they still have to pay the port anyway. This internal demand creates a permanent revenue floor. Before JSW Infrastructure even finishes pouring the concrete for a new terminal, they already know their parent company's guaranteed payments will cover the overhead. With the fixed costs already covered by the family business, any external third-party ship that pays to dock at a JSW port drops straight to the bottom line. The company has deliberately chased this outside business, successfully pushing their share of third-party cargo up to 49% of their total volume. Commercial rates charged to outside shipping lines are significantly higher than the internal transfer rates they charge their own parent company. The first bar shows the captive cargo remaining static, acting as a permanent foundation. The second bar shows the third-party cargo growing. By shifting the mix toward outside customers, JSW untethers its revenue from the internal cycles of its parent company. By using internal cargo to de-risk the construction, they can then sell the remaining capacity to the open market at a premium. It's a guaranteed floor combined with high-margin commercial growth. JSW is now redirecting the substantial cash flow from these maritime operations toward the interior, acquiring the assets needed to control the entire delivery route from ship to factory. They are building inland container depots, dry ports far away from the coast, and buying up private freight rail networks to haul cargo deep into the hinterland. The financial scale of this inland pivot is ambitious. By fiscal year 2030, they are targeting 8,000 crore revenue just from this new logistics segment. Owning the trains and trucks that connect to their docks creates what JSW calls sticky cargo. Shipping companies stay with JSW ports because they can hire one single operator to handle the container from the middle of the ocean all the way to the factory floor. Ultimately, JSW's true genius isn't pouring concrete or buying cranes. It is the financial architecture that uses guaranteed internal demand to de-risk capital projects, turning a capital-intensive utility into a compounding profit engine for global trade.